Welcome to our deep dive into the world of finance. Today, we're exploring a topic that's been making waves in the financial markets, the surge of the 10-year U.S. Treasury yield. As we unravel this story, we will use insightful visuals to help illustrate the trends and implications of this significant economic indicator. As of April 2025, the 10-year U.S. Treasury yield is capturing major headlines, climbing to heights not seen since late 2023 and early 2007. This yield serves as a critical benchmark for various economic activities, influencing rates on mortgages, student loans, and other financial products. Let's take a look at a graph that illustrates these trends over time. Historically, the yield on the 10-year Treasury note has been a reliable indicator of investor sentiment and economic health. Recently, it has experienced fluctuations driven by multiple factors, including stronger-than-expected job reports and shifts in Federal Reserve interest rate policies. Here's an image showing the trends of the 10-year Treasury yield from 2007 to 2023, highlighting the significant rise in 2023. Just a few months ago, in January 2025, the yield surged to levels not reached since November 2023, reflecting market reactions to robust employment data and inflationary pressures. This surge took place as the Federal Reserve began to adopt a more cautious stance on interest rate hikes. Let's visualize this with another graph that captures the fluctuations in yield over the past few years. Currently, on April 11, 2025, the yield stands at approximately 4.51%. Analysts suggest that the consistent rise in yields since late 2023 indicates a changing economic backdrop, with potential implications for future borrowing costs across the board. Here's an image that illustrates the trends in the 10-year Treasury yield spreads, which can provide further insight into these economic conditions. In response to these market movements, investment strategists remain divided on the outlook for Treasury yields. Some forecast a possible dip back to around 3.5% in the coming year, while others believe strong economic indicators will keep yields elevated in the near term. Let's take a look at a graph that depicts the daily U.S. Treasury yields alongside the effective federal funds rate, highlighting the relationship between these key financial metrics. With the Federal Reserve's interplay in adjusting short-term rates and managing inflation, the trajectory of the 10-year Treasury yield will remain a focal point for investors and economists alike. Market analysts emphasize that monitoring these trends will be critical in navigating the changing landscape of U.S. financial markets in 2025 and beyond. Here's a final image summarizing the trends and forecasts for the 10-year Treasury yield. We hope you found this exploration of the 10-year Treasury yield insightful. What are your thoughts on the current trends? Do you think yields will continue to rise or stabilize? Share your opinions in the comments below. If you enjoyed this video, please like, share, and subscribe to our channel for more engaging content. Don't forget to hit the bell icon to stay updated on our latest videos.